Welcome or welcome back. Elevance Health reported earnings this past week, and I uploaded about the stock before earnings, calling it one of the top stocks for 2026. So I wanted to provide an update for you and let you know if I still think the stock is a buy. And I'll also give you a valuation in this one so we can look at what it might be worth 5 years out. As you can see here, quarter four adjusted earnings per share beat estimates. Revenue was up year over year. It was a slight miss on revenue, and the stock had actually struggled before earnings even happened after the Centers for Medicare and Medicaid Services proposed just a 0.09% payment rate increase for Medicare Advantage plans in 2027. And that could obviously negatively affect companies like Elevance Health. So you can see that the stock actually sold off Tuesday, January 27th on that news anyway. And then on earnings, it actually recovered a lot of those losses. So the earnings report was actually apparently perceived pretty well by the market. Now, what I really think the market probably really liked about this report was the guidance. So the 2026 adjusted diluted EPS guidance that they issued was for at least $25.50 per share. And then they actually said 2027 adjusted diluted earnings per share is to grow at least 12% off our ending 2026 earnings baseline. And on the call, I think I was skeptical of this at first. And on the call, I think maybe I wasn't the only one. The CEO, Gail Boudreaux, was asked about this 12% growth target. Hi, thanks. Maybe just big picture, if you could give us a little bit more details and speak to what gives you that confidence to confirm the long term EPS growth target of 12% plus starting in 2027 in light of the trends that you've seen in the past 2 years. Is there something specific in Medicare or Medicaid or the commercial markets that suggest an opportunity to start growing earnings in 27? Or are you seeing something in Carolyn's side that maybe leads to a stronger acceleration of growth here? And lastly, I assume this includes your view of the 2027 MA rates post the prelim notice. When she responded to the question, she noted that they are guiding for an adjusted diluted EPS of at least 25.50 in 26. And I do just want to point out sort of the end of her answer to it. I'm not going to read through the whole thing. You can do that if you want to pause the video and do that. But she said at the end of her answer, or toward the end of her answer, and third, I think this is really important to your question. The path isn't predicated on a single assumption, it's built on multiple independent levers and disciplined execution across commercial, Medicare, Carelon, and Medicaid. And that's why we have the confidence both in the 27 and our long term earnings algorithm. And that confidence is behind our outlook in 2026 and the growth in 27. So hopefully that provides some clarity. So she's claiming there's multiple levers that are going to allow them to have this earnings growth in 2027 and beyond. And as I said, I was skeptical of this until I did start to crunch some numbers on it. And I do actually think that this is possible. So we'll take a look at that toward the end here. But let's take a look at my valuation now. So for fiscal year 2026, I'm projecting revenue of $197,170,000,000. That's down slightly. So ELV is forecasting a low single digit decline in total operating revenue. And this is in line with that idea. I based the revenue assumptions here on analyst estimates for fiscal year 2026 and 2027. Now, total operating revenue is slightly different from total revenue, but this is in line with that. Those analysts' expectations seem to be in line with what Elevance is saying about their total operating revenue assumptions. What I then said was, okay, so what if they could grow their revenue 8% in 2028, the 2028 fiscal year, and do that through the 2030 fiscal year? You can see here the 3-year revenue CAGR for this company is 8.3%, the 5-year revenue CAGR is 10.3%, and the 10-year revenue CAGR is 9.7%. So if they can get back to growing their revenue at 8%, a couple more years out, I don't think that's that lofty of an assumption. I then took a look at their historic net income margins, and from fiscal years 2015 to 2025, their highest net income margin was in 2019. It was 4.6%. Their lowest net income margin was 2.84%, which was actually in 2025, this just past fiscal year. So the mean average there of all those years was 3.71%. So if they can get back to their mean average and then buy back 2% of their shares over the next 5 fiscal years, you'll have earnings per share after fiscal year 2030, if all these assumptions remain true, of $46.99 a share. Now, this is, this, if these are GAAP numbers, this is different from adjusted diluted EPS. But if we just look real quick, if we take 25.50 for the 2026 fiscal year, and then we say they're going to grow at least 12% in 2027, 2028, 2029, and then 2030, you get $40.12 of adjusted diluted earnings per share there, which that's actually lower than this number that I'm getting here as a possibility. So I was kind of looking at it like, I don't know, that sounds like maybe that's a lofty goal, and maybe they don't get back to that. This is a turnaround play, so it doesn't have to happen, but I don't think that their expectations are as lofty as maybe it first sounded. I think that this is actually possible. I also took a look at their dividends, and you can see the growth rates I factored in here for each fiscal year. And if we look, I have the total proceeds after fiscal year 2030 with the stock price at different PE ratios, and then the dividends that I've calculated out. And if this stock could trade at a PE of 15 after fiscal year 2030, you could be looking at 117% on the upside here based on what I've calculated from the last close today. Now, I think that the stock could trade at 15, 17 and a half, 18 times earnings. I think that these numbers here, so could it do 151% over the next 5 years? Yeah, I think it could. I think it could even trade closer to 20 times earnings. If the sentiment around this industry improves, I think that this stock could trade at a higher multiple and do quite well going forward. So I do still think that ELV is a solid buy. If we look at the chart, it's sandwiched in between the 100-day and the 200-day, but you did have a crossover of the 50-day and the 200-day recently. So we'll see where it goes from here. I thought it was breaking out already when I made that past video, but then the news cycle hit, and you can see here that, you know, things, technicals are great and they're helpful, but they don't it's probabilities, right? So it is a turnaround play. It might take some time for this one to play out, but I think that it is still a buy. If you've got a time horizon that's long enough, I think it could have really solid returns. But it's not financial advice, it's just my opinion. Hey, if you found this video helpful or informative at all, please click the like button, subscribe, and click the bell to get future notifications. And follow me on X at Stock Sale Flyer for more regular updates on things I'm doing. And if you missed my last video on Elevance Health, make sure you check that out as well. Thanks, guys. Bye.